What if I told you that you can make $500,000 in real estate in just 5 years without ever pulling money from your bank account? I know this is possible because I've seen it happen. On today's episode of Talk Mortgage to Me, we're going to flip the script and I'm putting Dustin in the hot seat. He's going to explain exactly how he helped a client earn this much money in that short amount of time leveraging this strategy. So Dustin, how'd you do it?
What's up, Karina? What's going on, everyone in the HELOC world? So this is exciting for me because normally I'm the one asking the questions, and I bring in one of my friends who's a top producer to talk about real world scenarios where they have actually helped people navigate becoming a homeowner, as well as how to leverage the right financing tools, aka mortgages, in order to achieve their home purchases. And the one thing that I've always believed, I practice this, I coach it, I teach it, a consultant, is that there's no such thing as a one-size-fits-all mortgage. You see, mortgages must be tailor-made to match your financial needs, wants, and goals. And I fell in love with the mortgage industry years ago once I found that a mortgage was nothing more than a tool, or a mortgage was nothing more than a strategy that we could use in order to allow people to generate and grow wealth through real estate. So here's what I did. This is a personal friend of mine. He lives in Atlanta, Georgia. And for anyone who lives up in Atlanta, Georgia, they love to come to Florida, but they don't come to Florida like Orlando, Tampa, St. Pete, Jacksonville. They all go to the panhandle of Florida, aka the Redneck Riviera, Lower Alabama, or what they love to call, quote unquote, 30A. So my friend, who I've been friends with for 20 years, is wanting to buy a place in Florida, as he likes to say. Me, again, I hear 30A. And in order to do so, he needs to put money down because he's not buying this home as a primary home. He's buying this home as a vacation property. But not just a vacation property that his family can use, but it's a vacation property that he can also rent out via VRBO or Airbnb. But my friend doesn't want to touch his assets. Now, he has enough money in the bank for at least 10, if not 20% down, and he has plenty of money in his investments. However, if he takes money out of his bank account, well, there goes his rainy day fund. And if he takes money out of his investment account, he's going to have to pay capital gains taxes on the money that has earned him over the past 5, 7, or 10 years that he's had that money invested. So here's what I do. I look at his situation. I recognize that he already owns his primary home in Atlanta. He and his wife have owned that home for 15 years. It's where they've been raising their 2 daughters, and they only owe about $200,000 on the house. However, the home's worth about $600,000. Now, the condo he wants to buy is a $400,000 condo. So he's going to need about $80,000 to put down, plus another $10,000 in closing cost. And because he's going to be short-term rentaling this thing, he needs some money for some cheap, inexpensive, maybe even pre-owned furniture. So I tell him, let's go ahead and take $100,000 out of your home and let's leverage that $100,000 in order to purchase this condo, furnish it, and pay your closing costs. So instead of him taking the $100,000 that he did have out of his savings and checking account, instead of having him go into his investment account and sell a bunch of stock and pay taxes on those gains to raise the $100,000, I said, let's go get you a home equity line of credit. That HELOC will be for $100,000 because he has enough equity, right? He owns the home. It's about worth, $600? He owes $200. So us taking $100,000 out, all we're doing is leveraging equity from one property, the home in Atlanta that he lives in and raises his daughters in, to purchase the condo down in 30A. We take that $100,000, guess what? It's borrowed funds. There's no taxes you pay on borrowed funds. Now, sure, he has a interest payment on that home equity line of credit, but the good news is his interest payment is less than what his investment account typically averages. You see, his investment account averages between 8 to 12% rate of return every single year. The interest he's paying on his HELOC is about 7.5 to 8%. He takes that money, he uses it for a down payment, he uses it for his closing costs, plus he uses it to put some inexpensive furnishings in the property so it's rental ready. Now, he owned that condo for about 3 years before he sold it. When he sold that condo, he sold it for $550,000. So he bought it for $400,000. He sells it for $550,000. So cha-ching, he picked up $150,000. Now, the rent he received the whole entire time on that condo, not only did it cover the entire mortgage payment, but it also covered the entire HELOC payment. You know, that $100,000 that he took out on his primary home in Atlanta, the same home that his wife and 2 daughters live in with him. That rent covers the mortgage payment on the condo association dues, plus the HELOC, and it even allowed for he and his family to use the condo 3 weeks out of the year. So that's what he did in the first 3 years. Now he sells that home and he gets enough money to pay off the HELOC, but he doesn't. He also gets the $150,000 that he earned through equity and a little bit of paying his mortgage down. And now he has roughly $250,000 to buy the next property. Now the next property was $1 million home. That $1 million home, he does the same exact thing with. He buys it, he leverages, he never touches any money that was originally in his savings account or in his investment account. He has $250,000 to put into the transaction, which was roughly his 20% down plus closing costs plus money left over for furnishings. And when he sells that property, he sells it for $1.4 million just 2 years later. So he was able to purchase his first condo, sell it, roll those proceeds into the new home. By the way, this is for an entirely different talk mortgage to me, but he leveraged what's called a 1031 exchange in order to not pay capital gains tax when he sold the condo. But what he ended up doing, ultimately, bought the condo for $400,000, sold it for $550,000, bought the house for $1 million, sold it for $1.4. He ends up netting over $500,000 in just 5 years without ever touching his savings account or without ever touching his investment account.
Okay, but Dustin, how realistic is that?
Great question, Karina. It's like, look, is that realistic every day in every market of every year? Probably not. Did that really happen? Yes. Is that a new strategy? No. I mean, we were deploying this strategy in the early 2000s. We were deploying this strategy in 2014, 15, and 16. Like, yes, my friend benefited from massive amounts of appreciation happening between 2020 and 2025. However, the theory itself still works. Now, maybe it's $500,000 in 7 years from some people, or maybe the same scenario only would net $250,000 and not $500,000. But at the end of the day, let me ask you this. Where else can you go and turn $0 into $250,000 in just 5 years?
That has to be somewhat risky though, no?
I mean, look, anything you do is going to bring risk. Me investing in NVIDIA stock brings risk. Me buying any second property brings risk. Me doing a 100% commission sales job is risk, or me opening my own business is risk. So yes, you have to be able to assume and stomach the risk involved. I always ask people to think about your worst case scenario. Like, what was the worst case scenario for him, right? He had $400,000 of equity in his home. He could afford the payment on that HELOC if he didn't have enough rent to cover, and he could even afford the payment on the condo, whether or not he rented it or not. Now, he wouldn't have made the decision he made to buy if he didn't think he'd be able to rent the property. He wasn't looking to have a $30,000 or $40,000 a year luxury item. He was looking to own a piece of real estate in a desirable area that he and his family could use. And his mitigated risk analysis showed him that based on historical data, he would be able to rent the property. The rent would cover both the payment on the mortgage he took out to buy the condo plus the payment on his HELOC. But because there is a slight risk in anything that you do when it comes to real estate investment, he did have to prepare for it. And the one thing I suggested to him that I would suggest to anyone tuning in is you have to be able to go at least 6 months carrying all of the payments without collecting any rent before you go and do something like this. And additionally, I don't think you've asked this question yet, Karina, but I'll go ahead and put it out there. Like, this is someone who was already fortunate because he had already owned a home. He had owned his home for a long enough period of time that he had built substantial wealth. Now all he is doing is leveraging the wealth in his first property to go out and acquire more properties. It's one of those things where sometimes it takes money to make money.
Wow, what a cool story. Thank you so much for sitting in the hot seat today. Y'all, if you all like content like this, make sure you give a thumbs up and subscribe. If you need help buying a house, click the link below.
That's right, guys. Make sure you subscribe to this channel, especially if you like this type of content. Click the link below because that's how I can make sure you get connected with one of the TLOP approved real estate and mortgage professionals in your area that can walk you through how you can build more wealth through homeownership. And finally, if you like this type of content, remember, sharing is caring.